Are you seeing me? There we go. All right. Thank you again, Dr. Nashwa. And let's move on to our next session, capital markets digitization, the new norm era. And in this session, we'll be asking, again, very, very complicated questions on how did the digital trading help mitigate some of the consequences of COVID-19? What is the role of fintech in providing the natural solutions to the demand of rapid digitization? And will this be the new norm? Moderator for the session will be Dr. Konstantin Sarioan, Secretary General, Federation of Euro-Asian Stock Exchanges. Our speakers will be Rami Al-Dukhani, Secretary General of the Arab Federation of Exchanges, Namir Khan, who is Chairman of MENA FinTech, Noha Shakir, Founder and Secretary General of the Egyptian FinTech Association, Vice President of the African FinTech Network. Thank you.
Thank you, Mr. Ashraf. And can you hear me well?
Yes, we can hear you well.
Yeah, great. So dear ladies and gentlemen, greetings from sunny Cyprus. It's really great to have a break in vacation from sun buses, beach and cocktails, and to join this discussion on this panel. I really like the discussion. I really like the first panel topics and what has been discussed there. And we are going further with our panel. And so the topic of our panel today is digitization. That's digitization of the capital market in new era. So the post-COVID and during the COVID, what we had. So let me briefly introduce the panelists and the speakers. How we're going to do, we will have a short introduction, very brief one of the speakers, and then we will jump into the discussion with the panel. So let me first introduce myself. I'm Konstantin Saryan. I'm holding a Doctor of Economics degree from Yerevan State University. I'm a Secretary General of Federation of Euro-Asian Stock Exchanges. Also, I'm a chairman of the Institute of Directors here in Armenia, and my relevance to the fintech is that I'm also a club member in the Angel Investors Club, and also I'm a mentor in several fintech projects in Armenia. Also, I'm alumni of INSEAD International Directors Program, and that's it briefly from my side. Now, I would like to ask Noha Shakir, our female speaker in our panel, to introduce again briefly. Dear Noha, floor is yours.
Thank you very much, Konstantin. Well, it's a pleasure to be here amongst you today. I had a lot of fun listening to the speeches and discussions that were actually raised so far. Well, in short, I founded and I'm currently running the Egyptian FinTech Association, which is a non-for-profit that mainly works towards the digitization of, and actually not just the digitization, making the financial industry more accessible to the average small and medium businesses as well as individuals, democratizing finance, as we call it. I'm also the elect vice president and one of the co-founders for the Africa FinTech Network, which is another non-for-profit that is based out of Nigeria that works more or less towards the same objectives added to the Africa market integration objectives and, of course, financial inclusion. I also serve as the lead of digital innovation for FSD Africa, which is the third non-for-profit that works more or less towards serving the same objectives. I come from banking background, and hence the start of my interest in fintech around 7 years ago. Thank you. That's in short.
Great. Thank you, Noah. Thank you. Our next speaker is Namir Khan. Namir, can you please also highlight the parts of your career or your responsibilities in fintech?
Thank you so much, Constantine. It's a pleasure to be here. And thank you to Dr. Farid as well for his great introduction. So Namir Khan, Chairman of the MENA FinTech Association, what we do is we work very closely with the central banks, the regulators across the region. Most importantly, we're currently focused on policy making. Community building is one thing, but policy making, ensuring that we have the relevant policies that basically enable fintechs who are coming into the region or being given birth in the region to have a lot more positive roadmap as well ahead of them. Some of the areas currently that we're strongly focusing on starts from, of course, open finance, payments, capital markets, and currently this has been one of the most important topics, which is basically focusing on sustainability finance as well. That's pretty much about it, and look forward to the exciting session.
Thank you, Namir. And last but not least, my colleague and friend, Mr. Rami El Dokani. Rami, just briefly introduce yourself. We know a lot about you, but especially related to
it's a panel of friends. And what I love about this panel specifically, that all of us are good friends. And I just saw, it just hit me in the mind, the resemblance that Secretary General should be as bold as everyone. For me and you, we have that in common. So I love that. So I had the team here in the Arab Federation of Exchanges. We're the house of 17 Arab exchanges and 3 clearing houses, and a lot of affiliate members of commercial banks, brokerage houses, asset managers, technology companies. Before that, I was a typical boring investment banker for almost all my career. And a few years before joining AFE, maybe Noha knows that, I decided to come a little bit cooler and start wearing jeans and attend meetings on beanbags and started a fintech VC out of Cairo. That's what gained my attraction to fintech. Then they elected me to come to AFE, so I had to be boring again, wearing suits and meet high-profile people. But every now and then I love to go down and talk with startups and everything. We're big on fintech, we're big on digitization. We try to push this agenda heavily with our members. We believe that capital markets, in essence, is a technology play. The entire infrastructure is based on technology. And if we do not improve and enhance the user experience, we'll be lagging behind everyone else. Hence, we've signed with my dear friend Namir a few years back a memorandum of understanding for cooperation between both our institutions. We created a FinTech and Innovation Committee under the board of AFE, especially looking into main topics and working on that. And we dedicated a lot of our resources internally to study and work on that topic heavily. That's it.
Great, thanks. Thanks, Rami. And let's jump into the discussion. Just a short introduction from my side. I mean, a couple of words. So everybody knows that COVID changed a lot, and what has been changed significantly, that COVID put us in an extraordinary conditions, circumstances, which currently we can call on already a new norm era, especially when it comes to financial markets. And financial markets reacted quite actively, very fast in terms of digitization of the processes. Some of the processes, and by the way, it's a different approach what we have seen due to COVID, because before that the financial markets, they have been moving toward the digitization, but that movement has been forced by the efficiency, by the increasing efficiency. And in some countries, what we see that some of the digitization has been done compared to what can be done, let's say, using a manpower. Manually, right? So people have been comparing whether I can do this process by hiring, let's say, 10 people, or rather than having a new technology. Due to COVID, these also do not work. This works completely different, because it's not the comparative analysis of what can be done efficiently. It's rather another thing. When it comes to the healthcare and etc. and safety. So the COVID changed a lot and pushed the digitization. And now the question is the following, and probably Rami you can probably highlight on this. What are the issues in the capital markets which can be also covered by the digitization of the infrastructures and institutions? Just highlight the issues, and then we will go to our panelists to understand what their view and how they see also the solving of those issues. Please, Rami.
So, let me begin by simply saying that capital markets today remind me with banks and commercial banks maybe 10 years back, when they stand by the fintech and the innovation agenda. Banks 10 years ago, they used to look at fintech and innovation as like a simple game that they can play along and they can win it because they're bigger, they have the muscles, blah, 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 blah. But time proved them wrong. And I don't want to say that time will prove capital markets wrong as well if that didn't change, but there are a lot of things that could be tackled. Let's first of all think of the investor or the user or the consumer as a normal human being. That financial services for him is a normal trend and development. First of all, he graduates, then he needs a checking account in his bank, then he needs to get his salary, then he needs a credit card, then he starts making much more money. He starts thinking of savings and investing around. So it's a normal progression for the financial services need of any consumer. However, we always deal with this investor or this consumer as a standalone, as a different type of person or a different type of persona versus the one who goes to the bank. No, I would like to think of him as a normal person. Like all of us, we have checking accounts at our banks, we have credit cards, we have loans, and then we invest into several instruments. One of them could be the capital markets. So the first problem that is always tackling, especially in our region, whether in the Arabian region or the African region, is the KYC or the onboarding process. It's hideous, it's long. I love to call it kill your client, not know your client. It's very boring. You have to go and open and sign a bunch of papers. This could be justified in banks because they have a huge network of branches. But look at the industry itself of capital markets. The cost structure is very limited. The margins are very thin that will not allow you to open a huge branch network or hire too much human resources just to hunt down more investors. So basically, they will always be targeting the big fish, the one with the big money, the one with the big portfolios, in order to justify the cost of opening this bank account. The second thing is, why don't we attract the youngsters? The younger generations are always away from investing into capital markets. I would assume that the average age of investors in the region will not be lower than 55 years old. Although all the statistics, and I know my dear friend Dr. Farid is online, and EGX specifically had this very interesting statistic saying that investing in capital markets definitely yields higher return from any other investment than any other return over a period of an extended period of 10 or 15 years. Will definitely capital markets will be yielding higher returns. Yet younger generations are away from this market. The third thing that we need, especially after COVID, everyone started thinking of how can we reduce the cost structure? How can we be more efficient? How can we create more value from the technology that we are using? So many ideas of sharing the infrastructure costs between different players in the market started to arise. Especially on the post-trade infrastructure, whether CCPs and CSDs, we have seen many trials in the region of connecting several players in different countries via blockchain in order to execute transactions and do the clearing process. Because having a CCP is a very, very expensive piece of infrastructure to have. So if you do not have the proper volumes or the deep pockets to have it, it wouldn't be justifiable. Yet it is a major or a vital attraction for international investors to come in to have a CCP. So sharing the infrastructure would be definitely a better play. For me, I would say that these would be the major things. The fourth one is, this for me is a little bit, I don't want to say hypothetical, but everyone might share this point. Our markets are inflationary markets by nature. People love putting their money into real estate, but investing in real estate, you need deep pockets and huge tickets. At least you need $100K to buy a proper piece of real estate that could be tradable on the market, and you can exit and make returns out of that. But how about frictional ownership is not there yet. If you tokenized this piece of real estate and then allow 100 people or 1,000 people to start sharing or selling and trading this piece of real estate, you'll have more liquidity listed on the markets. You'll get more liquidity from an off-market transactions to the official markets. So these are the 4 areas that I would say that are my priority list to move.
Yeah, thank you, Rami. So according to your list, again, we have increasing client base, inclusion of younger generation, cost structure, which, by the way, one of the questions we have currently in the chat, and we should focus on that as well, and post-trade, and of course, new assets like real estate, based on real estate assets. So my question will be to Noha and Namir, and Noha, probably let's start with you. So which of these issues can be solved by digital solutions, and if you can bring us some examples regarding so how each of that, probably you have seen that some examples, some good examples or even bad examples that will also be useful for everyone.
Thank you very much. Well, before I attempt to that, I'd just like to comment a little bit about the challenges that Rami has just shared. It takes 20 to 30% of the time of a relationship manager to actually do an onboarding and a KYC for a potential customer. The large investment banks have an average of 1,000 plus employees who are mainly dedicated to the client onboarding and KYC processes in there. And it takes an average of 60 days in the most efficient, advanced banks to actually onboard an institutional client. So getting back to what Dr. Farid has said, that we want to integrate capital markets, grow our investor base, and what Rami has just mentioned about involving the small investors and youth. This cannot be achieved with our structural cost involved in the end-to-end process as such size and volume. So we have challenges related to identifying future opportunities for growth for the market, including the youth. We have challenges related with the structural costs that are involved into the process. And we have also a challenge, just like Dr. Farid has just mentioned the repo and the fact that we're encouraging more investors to get into purchasing state owned and raised investment instruments. Actually, to deliver on the regulatory requirements that goes hand in hand with such regulatory changes is very, very costly if you are going to do that using the manual and heavily invest in human capital. Okay, so where are the areas where fintech and technology can actually add value? If we look at the process end to end, fintechs can add value in the client servicing part of the process. That includes the client onboarding with digital AKYCs and the like. It involves, of course, client insights and analytics to drive those educated decisions, relationship management. In the case of mergers and acquisitions, this can also be a very effective tool to actually cut the time involved and the processes down. In the trading, you can look into the post-trading processes. You can look into the actual trade execution. You can look into the post-trade analytics and the like. There are fintechs that actually are existing that I would be more than happy to mention certain names in certain markets that have actually covered that. If we look at the post-trade operations coming from a banking background, and I was really involved within transaction banking, so the custody guys and the challenges that they face actually on the ground, doing all the processing related to the treasury operations itself, the custody and asset servicing operations. I mean, those were huge. When it comes to tax operations, it's like Rami perhaps can elaborate on that later. There are real challenges on the ground when it comes to applying taxations. And now you actually have the technologies and the fintech startups that have built solutions to overcome those. Risk control and risk management is another area. Compliance is a key and a huge area as well, where fintechs can add value. And I haven't mentioned or covered all the areas yet, but those are all parts of the process where using a fintech solution can actually help improve efficiency and accordingly affect the pricing of each and every service that we offer. And of course, it would affect the increase in the customer database and serving the youth, as Rami has said, and SMEs as well. It's like we have a comment in here from John on the chat. It's like saying, where are the services that are customized for SMEs? You only focus on big institutional investors and SMEs are left out. The fact is not because investment banks or capital market authorities are bad people and they don't want to involve SMEs. It's like serving those customers, SMEs and small investors, with given the current brick and mortar non-digitized processes has proven to be non-profitable. It cannot work. So fintech is the answer to all those challenges on the ground. Thank you very much.
Thank you, Noah. We will come back to you with some probably some again examples and to point out how particular that can be solved. And Namir, so Noah has pointed out some details regarding how much usually banks and financial institutions are spending for KYC, for example, and that's of course not only increase the costs of the entire transaction or the identification process, but also it makes the process itself longer, which in the era of digitization is quite ridiculous, right? So we are expecting that we can open an account with a one click, we can do a transaction with one click, and everything to do with one click. And when there is a 2 or 3 clicks, so we are complaining that, oh, it's so complicated. So Namir, so what's your point? What's your view on these issues, which Rami also raised, and also regarding KYC, etc.?
Thank you, Konstantin. So basically, in terms of the KYC issues in particular, the pressing issue is currently how quickly can we onboard the customer and how quickly can we basically make the customer to trade. That is, the key indicator and the key KPIs for most of these fintechs, capital market fintechs that are coming in. To name a few, I mean, Thunder is there, then we also have Baraka, then we have Sarwa. All of these platforms are going towards, equity market trading as well. And the core conversations that they all are having at the moment is the same when they are speaking to a retail investor. That is fundamentally one is that there is number one, zero trading free, which is of course been a quite debatable conversation. And of course, when it happened in North America, it was then followed up by the leading organizations and institutions to basically then follow that same path as well. Simultaneously, it is as long as you have a cell phone in your hand, and it's as basic as that, right? So the simple basic proposition is to basically open up an account as quickly as possible and then start trading, and it's actually as quick as possible. Now, one of the things is that how do you make trading so quick and so instantaneous? This is where these fintechs then, which I think this is where we have to follow the learning curve of what has happened in North America and what is also happening in other parts of the world and how it could be done over here as well. So learning from the fintechs is not a bad experience, it's a great experience. So how do they make this experience entirely fluid is the question. So a fintech is also a combination of multiple APIs plugged into that specific platform. Whereas when we're talking about a fintech, let's say, I just named 3 of them. All 3 of them would be having a KYC solution or KYC partner that is doing their KYC instantaneously. One. Secondly, then the question comes in, how quickly do you fund the account? That was a major problem previously as well. How do you fund the account to start trading? So if you put in your scheme card, which is your Visa and your MasterCard, that also has an additional cost attached to it, right? So why don't you use open finance? Why don't you use open banking? Why don't you connect the rails instant and do it without any additional cost to it, right? So, and it's all instantaneous, because I mean, there was a banking transaction that we did yesterday with one of the capital market fintechs. It was, kid you not, 2 seconds, the account was funded. That was how quick it was, right? Now, the point is that this is the fluidness that we need to bring in when it comes to, and you see, the other thing is I would like to also address, fundamental point is that we also see some competition raising out for the existing players that, okay, we would actually lose out a major chunk of the share to these fintech platforms. Yes. Now, the thing is that one of the reasons why this is there, that these platforms now are also getting support from the regulators themselves, right? Where the regulators are coming up with promising policies itself when it comes to enabling instant KYC. This is where the regulators will play a key role. So if the regulations are coming in from the regulators top down, that, okay, you know what, players, you need to go towards this because we want this, because as long as the state's interest is basically aligned, the regulators will push relevant policies to ensure there's more capital coming in. Now, one of the reasons why these fintechs are also raising a lot of funds and a lot of fundings are coming in, and the investors are putting the money behind them, is for the fact that they do see a lot of retail boom in the next, as close as 12 months and as medium term as 5 years. The retail evolution of the younger user base, which Rami was highlighting, is only going to evolve at a very significant pace. So for me, the major core problems are going to be that I've addressed. That KYC, as Noah mentioned, every single fintech has a vertical that they're working with. So for example, KYC has a vertical, onboarding has a vertical, and all of these players are working with each other. So the point comes in is that, see, you may have these issues, you may have these problems, but you got to figure out a way how to basically work with these players, open up your APIs, open up with these platforms, and try to piggyback on it. So one last thing I would like to say before I disconnect on this point is going to be the models, how the models should evolve. A model could not just be basically, broker as a service, right? I mean, why can't you basically offer your license to a fintech and start operating? So as banking as a service is becoming a model, right? That's the evolutionary models that we need to work on as well when it comes to capital markets.
Good point, Namir and Rami. I guess now the question is to you related to how this cooperation can be built. And when we're talking about model, Namir just pointed out that probably we can find some solution business-wise, because we understand that usually banks and let's say conventional financial institutions, they are looking on fintechs a little bit from the above, and so what they can do and how they can solve the problems. So basically, they do not so willing to cooperate with them. So what models can be implemented? Probably the regulators can step in here, or how you see that?
I remember on a previous discussion between me and you, I told you that what I love about Singapore, for example, is the single regulator model, that you have a single regulator that regulates everything and does everything for everyone. The main problem that I'm seeing today, that you have a regulator for the banking services and another regulator for all the non-banking services. Yet for me, the client is the same single person, right? So you have to regulate him by 2 different regulators for a service that I totally believe is a normal and a typical evolution for his needs, as long as he progresses in age and time. Cooperation has to start first between regulators in a single country to allow the improvement that one regulator is doing, to share it and share this experience with the other regulator. For example, as we're talking about KYC, you will find that central banks usually in the region are doing a fantastic job when it comes to this topic. Capital markets regulators are lagging a little bit behind. They still don't know it. They still don't understand how to do it, what kind of technology and stuff like that. So perhaps if these two just connect their minds together and understand this is a typical financial service and you're KYCing exactly the same person, you can start looking into, okay, we do not need to duplicate the KYC, even if it's a digital KYC, you do not need to duplicate it, you just need to share it with each other. The second interesting fact that most of the big capital markets or the brokerage houses in the region are actually owned by commercial banks. And yet they have totally independent operations when it comes to KYC, when it comes to compliance, when it comes to custody, when it comes to everything, they act totally independent. Yet they do not share the client list, for example. They do not cross-sell the products of each other. They do not cross-sell opening accounts for each other. So this kind of cooperation that should happen first within the financial services world, that would definitely unlock too much value, first of all. The second part is the cooperation with the fintechs and the startups. A lot of us have seen players in the industry, in the region, trying to become digital, right? And trying to proclaim that they're doing the funky way of doing the business. Maybe they're not doing it the right way. However, we have seen other startups and brokerage houses in the region. They started as a typical fintech, and they got their license as a fintech, and they got their license from the capital markets regulators as a fintech. And they introduced like the Robinhood model, for example. This is a typical formula, and it came from the simple fact, and I shared with them this view, the subscription model, there's no commission, zero commission basis. And the first question I asked him, how expensive is your subscription versus Netflix? So that was the simple question that I wanted to ask, because if it is as cheap and affordable as just clicking on a button for $4, I'm subscribed, then I'll definitely do it. You will not feel it every month, right? So by that, you're sustaining a revenue stream for this startup, for this brokerage houses, regardless for this person is actually consuming or using the service or not, but you're getting a constant revenue stream, as simple as that. So this is one fact. So they're doing fantastic because it's simple. I don't feel it. I don't feel the $4. I don't feel the $11 if I have a premium or taking a family package, for example. I don't feel it every month. So that would be as simple as that. So they liked the idea and they introduced this fact. And I believe they're doing well. The second problem that Namir has just said is how do we fund the portfolio? How do we fund the account? This is the typical and the fun side that in many countries, like in Egypt, for example, till now, you cannot fund your portfolio using cards. You have to either do a wire transfer or a cash deposit in the broker's bank account or in the brokerage house. You cannot use the cards because 10, 15 years ago, the only cards was credit cards. There wasn't debit cards in place, though the regulator said, no, you cannot use credit or money you've borrowed to start investing in capital markets. Makes sense 15 or 20 years back. It doesn't make sense today. So we try and we talk to regulators, hey, you need to allow card transactions to fund the bank accounts. On KYC, there's a lot of trials in the region, especially in Egypt, in UAE, in Saudi, in Jordan, for digitizing KYC for banks, basically. But the solution is still the same. Again, you're KYCing a person, not an institution or not a financial service. So the person is still the same. You're still taking the same ID. You're still taking the same everything. And we've done an exercise here in AFE. We've studied the differences between the KYC requirements to open a bank account in a commercial bank versus the KYC requirements to open a trading account with a brokerage house. By 99%, the information are still the same. So they're totally typical, they're totally the same. So it could be easily shared, it could be easily looked at as, again, think of him as a typical same consumer. Okay. So what we're trying to do in institutions like ourselves, FIAS or AFE, what we try to do is try to create more hackathons, more cooperations. We try to introduce our member exchanges to different solutions every now and then. We bring in the startups for meetings and webinars and tell them, okay, you can use this solution. How about we can push around that? We fish behind and we try to go deep in with our members to understand their own agendas in digitization. Everyone is hot in digitization. I bet you, if you talk to any of your members, they will tell you digitization is on the top of the list. Okay, what you're doing actually about digitization, everyone will tell you that we have digitized the General Assembly meetings, right? So that's, so that would be the fun side of it. No one is actually doing a real action. No one is actually putting some money behind it in order to understand where it's going to go. There's a lot of opportunities for cooperation. There's a lot of innovation in the region. Noha will tell you best, and Namir will tell you best about the quality of the people in the region, the quality of people in Africa, the quality of in the Arab states. They will tell you that we have fantastic minds, fantastic ideas. We've created a lot of hubs in the region, whether in Dubai, in Bahrain, in Saudi, and even in Cairo. You've seen a lot of entrepreneurs coming online and they have fantastic ideas. We need to encourage that and involve them more.
Thanks, Rami. Noha, you know, Rami has been talking about this cooperation processes, the integration between systems and sharing the information. So usually in minds of the managers of infrastructures, of the regulators, of banks, etc., when we are talking about integration processes and building the new technology, the first thing which has come to their mind is, oh, that will be costly, that will be a big project, we cannot do that, etc., etc. For example, the same we have seen in Europe when PSD2 or PSD, this directive has come into force, and everybody has been complaining that, you know, we cannot do that, this sharing, this old protocols, etc., implementing that will be costly. So what's your point of view regarding, for example, particularly when we're talking about KYC and we are talking about sharing the service between different participants, whether that seems so complicated from the technological side, or it's a matter of just a business model?
Well, thank you very much for the really interesting question. I mean, building on what Rami has just said, in order to enable such collaborations and seamless integrations amongst various players, the incumbents and fintechs, and even perhaps a regulatory authority in the middle overseeing the complete process end to end, you have to have the right regulations in place. I always like to use Egypt actually as an example. If you look at the regulatory changes that we have managed to actually push during the past 2 years, we have a fintech regulation issued by the central bank that enables and allows for open banking. And that is the very first step to achieving open finance and even open data. Just imagine, as Rami has mentioned, that the customer data, financial, non-financial, is all accessible by a simple digital identity, for example, where you can use technologies like a distributed ledger technology, a simple public key, private key to secure the data and who has access to it, and customers can be onboarded in a matter of seconds, a click away, like you said. The other key regulation that we've actually seen that is going to bring a lot of changes is the one that was launched by the Financial Regulatory Authority that actually allows for alternative forms of financing, like crowdfunding, for example, equity crowdfunding. This can attend to various needs, especially for the SMEs and for the small investors in there. Integrating that one way or the other with the incumbents and what they're doing, this can be a new revenue stream to the incumbents existing in there if you can build the right business model on the ground. So to attend to your question, can and is technology making such collaborations and partnerships feasible and less costly? The answer is definitely yes. Let us take only a few examples of technologies that are enabling that for the sake of time, and then a few examples of the fintechs that are currently there operating who have gained the trust of the incumbents and regulators to actually operate in markets like London and other markets in the US, whether it's Chicago or San Francisco or whatever. So, and another trend in here that we need to also raise and attend to is the actions that the incumbents has actually taken. They have built their own corporate venture vehicles to actually build and invest in fintechs that can facilitate the cost reduction, efficiency improvement, digitization of the end-to-end process and the like. They've built them themselves. And they have also built their innovation labs where it's like a miniature ecosystem, a private run ecosystem for fintechs where all players can come together to co-develop and co-create solutions that achieve those objectives to overcome the hurdles and the challenges that Rami has mentioned. What are those technologies? One that lies at the heart of it to facilitate actually trading is smart contracts. Smart contracts is mainly enabled by the distributed ledger technology that also had other applications in there. So if you're looking at clearing and settlement, this can facilitate the process in a matter of seconds. If you are looking at the actual trading process and that transfer of ownership, a smart contract can do that in a matter of seconds. If you look at another technology like the robotic process automation, for example, RPAs as we call it, that 20 to 30% of the time that is allocated to onboarding a customer plus that 1,000+ employee that is there to actually manage the relationship can be cut by 90% if you automate the process using that technology that is there, proven, and it's actually working. Artificial intelligence. We're not just looking at the buying side of the deal in here, the selling as well. You have AI applications that can recommend when is the right exact time to sell. So technology is making it definitely better. A quick examples before I end this, and you're not going to hear from me again until the panel is over.
Yeah, but very briefly, know-how, or either you can put it in the chat. Let's say some names because.
Okay, wonderful. So if you look at client servicing, look at Alpha Steam, for example. Look at data miners. Look at Origin. If you're looking at trading, look at Invest Lab. I Know First. BestX. Those are wonderful. For the data management, you have many of those. Market.io, IQ, you have Reddia. Reddia are doing really great. And I can go on and on and on across all the processes with the startups that are there. We are living exciting times, collaborative scene, not competitive, none whatsoever. Thank you.
Thanks. No, that was really interesting to hear the particular examples. And for closing this session, we have some comments and the basic question, which I guess also has been this topic has been raised by Namir regarding related to the transactional costs and to funding the account itself, both including funding the account, also the making the transaction. So how you see, Namir, how that can be reduced? I mean, because as Rami just has been telling that, for example, even debiting that from the card or funding that from the card is again costly. So if we are taking the cards like international ones, Visa, MasterCard, etc. So again, funding an account outside the card, so that will be the withdrawal kind of thing, and that will be costly. So how that can be solved? Or probably there should be another solution not related to the card.
Absolutely. So when you use a card interchange fee, that could be around 2.5%, right? So if you are basically expecting a return, so already do a 2.5% reduction on that, right, on your gains. Second is going to be what's the solution. So we were just talking about open banking. It's very important as a foundational structure. So most of the fintechs that you would see that are coming in now are using the rails of open banking, which basically states that you do not have to use a card. So user experience is simple. You download the platform, let's say ABC, trading. You download it, you simply go to your wallet, you connect your banks. There's an option. So that fintech is working with an open banking platform, which is connected to multiple banks at the back. You select your bank, you basically then tap in your login details, your credentials, your banking user ID and password, and then you authorize the transaction. So it is a bank to bank transaction, not a card to another transaction through a bank, which is 4 banks involved in that transaction. And plus the exchange rate, in case it's international transaction, that also differs. So typically, my simple solution would be utilize the open banking rails that you have in your country. And as Noha mentioned, there's open banking regulations in Egypt too. If I was there, I would definitely piggyback on that, and I would certainly utilize this in my platform. And I would also recommend other financial institutions who to basically at least test the use case of how this works. I mean, I can say this sounds rosy, but you have to use it. You have to see how fluid the experience is, and then you'll be able to then justify the experience. So I would say utilize at least open banking rails.
Yeah, thank you. Yeah, thank you, Namir. And we are behind of our schedule, so we are going to move to the next panel. And just final remarks from my side, I guess. Rami is right. So we have a lot of work to do as a federation, as an association, in order to bring fintechs and new technology to get familiar with the conventional financial institutions, and to try it, at least, as Namir said, just to try the new technology, to make a pilot project, etc. So thank you so much. Thank you, panelists. That was an interesting discussion. I guess we can talk a lot related to that topic, but we should stop here. Thank you so much.
Thank you for having